Well, good morning, great folks. Uh, this video is intended to help those learners at the junior or senior secondary who would want to have an understanding of basic accounting. So by the end of this topic, you are expected to define a cash book, prepare the two-column cash book, then balance of the cash book. So by definition, a cash book is a book of prime entry in which all the cash transactions of the organization are recorded. So what this means is that only transactions that are taking place on cash basis in an organization, they are the ones that go through the cash book. Now the cash book, by its nature, consists of what we call a cash account, a bank account, and the column for discounts. But this one, the discounts only affect the three-column cash book, which we'll be looking at in the next lesson. For now, we will concentrate on the cash account and also the bank account because these are the two accounts that form what we call a two-column cash book. Now, each book of prime entry is prepared from the source documents. So when we say source documents, we are simply looking at those documents from which information is obtained for us to record in each of the book of prime entry. So when we're looking at the cash book, the source documents which are assisting us to prepare the cash book are the receipts, checks, counterfoils, the cash sales, and also the deposit slips. Information is transferred from these source documents and recorded in the cash book. So to have a deep understanding of what a cash book is, we have the example that is specifically looking at the two-column cash book. It says, enter the following transactions into Bridget Marley's two-column cash book. Balance it off as at 30th December 2021. So the first transaction took place on 1st December, where they are saying started business with cash at hand, 300 kwacha and 400 kwacha at bank. Then on 3rd December, the business bought goods by check, 200 kwacha. 4th December, received cash from Porings, 100 kwacha. 7th December, sold goods by check, 600 kwacha. 10th December, cash purchases, 150 kwacha. 13th December, paid advertising by cash, 100 kwacha. So before we start recording these transactions in the cash book, we first of all begin to understand the accounts which are involved in each of the following transactions. So if we look at the first transaction which took place on 1st December, where they're saying started business with cash at hand, 300 kwacha and 400 kwacha at bank, you will discover that whenever they say started business, it simply means there must be capital involved. Because every time the business is starting, the owner of the business must prepare capital, either in form of cash or cash at the bank, or it could be other resources that the business or the owner of the business has invested into this business. All those, they form part of capital. So once we understand the accounts which are involved in each transaction, it's also important to ask ourselves questions. Which account was losing out and which account was gaining? So in accounting, when we say gaining, we refer to it as debiting because it is simply an accounting term to refer to an account having received something of value. In this case, we are looking at cash. So in the first transaction, when we say started business, the capital account is giving out money to the business because the capital account represents the owner of the business in this case. So it gave money in form of cash, which the business received, and also the other amount of money, which is 400 kwacha, was put into the business bank account. So our cash account was receiving money with 400 kwacha, and also the bank account was also receiving 400 kwacha. 300 into the cash account and 400 into the bank account, right? So how do we record that transaction, the first one? We will have to consider the date upon which the transaction took place. Okay, the date upon which the transaction took place. In this case, this transaction took place on 1st December, so the date has to be indicated in the date column, and also the account which is affecting the other account, in this case, which is the cash account. Then on 3rd December, we are also being told that the business bought goods by check worth 200 kwacha. So how is this account transaction going to be recorded in our cash book? First of all, there are two accounts here where they are saying bought goods. It simply means that these are purchases. In business, we refer to these as purchases. So therefore, the business has to open a purchases account, and also we know that we have a bank account which we have in the cash book. So if we are buying goods, it simply means that the bank account is releasing cash towards the purchase of these goods. Therefore, the purchases account is receiving and the bank account is giving. So how do we indicate this in our cash book? We have to show in the details column that we have got purchases, and these purchases are affecting the bank account. How are they affecting the bank account? The bank account is giving out. Okay, the bank account is giving out. So by giving out, it simply means that the bank account is supposed to be credited to show the releasing of cash towards the purchase of goods. Then on 4th December, the business received cash from Porings amounting to 100 kwacha. So again, in this case, we're supposed to identify the accounts, all right? The accounts which are involved in this transaction. Now, what are those accounts which are involved in this transaction? The first one, we know that there is Porings who is giving out money to the business, and the business is receiving cash in its cash account. Therefore, because it is receiving, our cash account is supposed to be debited by 100 kwacha. But the Porings will only be indicated in the details column. Okay, in the details column. Okay, Porings is indicated in the details column to show that the cash account was being affected by this account of Porings. So this is how the narration in the details column is supposed to be shown. All right. Then the other transaction which took place on 7th December, we are being told that the business sold goods by check. Remember, when you're in business, you buy and also resell those goods. The goods that we buy for the purpose of reselling, they're the ones that we call purchases in the business terms. So therefore, if we sell here, it means there are two accounts again involved. There is a sales account where they have said sold goods. It's simply a sales account is involved. Okay. Whenever we sell goods, the record is kept in what we call the sales account. So wherever they have said sold goods, it simply shows that the sales account is being affected. Goods are going out of the business we are selling. And therefore, from that sale, we realize some revenues. These revenues are recorded in the bank account. Okay, so in this transaction here, we sold the goods, the sales account was releasing out goods worth 600 kwacha, and the business received through its bank account an amount of 600 kwacha. Okay, so this transaction is supposed to be recorded in the details column. A narration is supposed to be indicated to say sales because the business was selling goods, and also the bank account is supposed to show receipt of these goods or of this amount worth 600 kwacha. Okay. Then on 10th December, we are being told that the business had purchased some goods worth 150 kwacha.